All right, everybody, we are here with some good friends. I'm here with my good friend Joe Zentner and Mr. Dan Deppin, who are just incredible in the note space. So today's interview and topic is we have a special guest speaker, Mr. Dan Deppin, who has um, a lot of experience when it comes into the note business. I'm not exactly sure, if he's done other, just traditional real estate investing, such as rentals and, any
No,
active type stuff. So no, so awesome. So Joe, how are you? Excited to have Dan on the interview here.
I'm doing well. I've known Dan for probably going on 10 years. I think I met you at the first Note Expo. Or no, I'm sorry, the first Quest Expo.
Oh, okay. Yeah, I think that
Yeah.
was 2018. Yeah, something like that. So,
Oh, that's crazy. Yeah, Joe was just telling me. I think I've known Dan longer than I've known you, and I was like, wow, that's pretty crazy. So
yeah.
Dan, tell us a little bit about who you are. What's kind of your background? If I'm not mistaken, I'm surrounded by two engineers.
Yeah, that's right. So I'm kind of on my third career. So I started, the first one was as a mechanical engineer in the aerospace industry for about 10 years. And then went to business school at University of Colorado and did my MBA. And then I went into the high tech world and was a product manager for about another 10 years or so. Worked for Oracle for 6 years and worked for AWS most recently as of about a year and a half ago. And then along the way, got into note investing. So I first started getting into note investing. It was like the beginning of 2017. I kind of discovered it. And for me, originally my plan was to do like conventional real estate and I wanted to diversify out of stocks a little bit. But even back then, the cap rates on rentals and the Denver market where I live weren't that great. So I was looking for alternatives and I found notes and kind of went hard down that rabbit hole. So I've basically pretty much stuck to notes since then. I've never actually owned a rental property. I've never done a fix and flip, although it's funny when you do notes, you kind of touch on a lot of other stuff. Like we can get into it later, but I've had REO properties that I've had to fix up, and so you end up like touching on all of these other things. Anyway, so but yeah, over the past 8 years or so, bought a lot of notes. At one point for several years was doing a lot of non-performing notes. I do fewer of those these days just because you can still buy them. You got to be a little bit more opportunistic. Today, I focus more on like the performing slash sub-performing notes. But then, especially when I was doing non-performers, when I would end up with REO properties, if I can, I like to sell them using owner finance. And so I created 6 or 7 notes of my own along the way through Call the Underwriter that last year ended up acquiring Call the Underwriter. So now I've kind of got two businesses. One where I focus on buying notes and a lot of outside capital to do that. And then another one where I help investors create notes. So, and now I've been doing that full time for a while.
Awesome. Yeah, I mean, sounds like you've had a quite a journey, getting involved in notes and just really diving deep into them. So, what was kind of one of the first things, or what caught your attention when it comes to notes? Um, what did that look like, and what was your first note purchase, if you will?
Yeah, sure. So for me, one of the things that attracted me to it is I hate like competing with a million other people who are trying to do the same thing, right? Like you go to business school, you're like, you want to be differentiated, you want to do other things. If you're just trying to do the same thing as everybody else and like be lower on cost, it's kind of a losing game. So if you look at the world of notes, like the market for notes is huge. I mean, the overall mortgage market, it's like whatever that is, like 13 trillion, some nutty number. But even if you narrow that down to like say the seller finance notes and some of the other things that are available to individuals, it's much smaller, but still really large. And there's a relatively small number of individuals like us or small funds that go around and buy these things. So really your success in notes is determined more by your ability to execute on things more than anything. But there's plenty of assets available. There's plenty of investors with self-directed IRA money and other things that they would love to deploy in the space, but aren't necessarily, they got other things going on. They're not necessarily going to spend the time, to get up to speed and do it yourself. So that was kind of what attracted me. So when I started in 2017, so I think it was like the beginning of the year, I found notes, and I can't remember exactly how I found it specifically. And then, I was kind of like studying it during the course of the year, following like some of the people that were around on YouTube and podcasts at the time. Not as many as there are now. And in fact, a lot of those people are gone too, which is interesting. And then I went to Node Expo in November of 17. That was my first Node Expo, because my attitude was like, if I'm gonna, it's a small niche market. I'm like, if I'm gonna participate in this, I kind of want to meet some of this cast of characters and whatnot. And then that December of 17 is when I bought my first note. And so the first one, I did it in a self-directed IRA. So I had to open a new self-directed IRA account because I didn't have one. I rolled over some money from an existing IRA, because one of the things like my brain defaulted to, I don't know why, I just assumed if I was going to roll over from a traditional IRA to a self-directed, I would have to roll over the whole account. And somebody told me, like, no, you don't have to do that. You can just roll over
Whatever
certain
you
amount. So I rolled some money over into that, and I bought a performing land contract in Council Bluffs, Iowa. Part of the reason I bought that particular one, this was like in December, it was getting to the end of the year. It was like actually a little later than this. It was like right around Christmas time. And my former in-laws lived in Michigan. We live in Colorado, so we were road tripping, and I was going right past Council Bluffs on Interstate 80. So part of the reason I picked that one was that I could pull off and kind of just scope the neighborhood and see what was going on. And it was cool because the neighborhood was actually nicer than what I was anticipating. So that was good. There was a lot of like pride ownership around the house, and things look good. So I ended up buying that note. And the whole transaction was pretty smooth. I hired a guy to help me kind of review the file, because I was doing the due diligence. I didn't really have a lot of like real training at that point. I kind of knew enough to be dangerous. So, I pulled in the O&E report and other things. And, I had somebody kind of help me go through that. We got that cleared up. And then on the pricing, what I did was I said, well, Note had been performing, and it was the other thing too, right? I was just starting, so I didn't have a good concept of what the market pricing was. And, the market is pretty opaque, and it changes over time. So my analysis process at the time was, I'm like, well, the notes performing pretty well. There was equity in the property. I'm like, this looks pretty safe. And I bid it at like a 13% rate of return. I'm like, yeah, that's pretty good. Which I backed in to my offer, which ended up being like 85% of the UPB. But I didn't realize at the time the market for those were selling at like 70 cents on the dollar, at the time. So I overpaid for the note, but it was still a really good deal. And I actually still own that note in my IRA, and it's been paying. So, I always tell people, like, I think one of the mistakes sometimes people make when they get started is they want like the perfect deal. So they want everything to be flawless, the docs to be flawless, the pay history to be flawless. They want to have, a borrower with 800 credit, and then they want like a 25% return. And so they craft this set of requirements that's like impossible to meet. And then they just do nothing for.
And they also want a discount.
What's that?
And they also want a discount.
Exactly. Yeah. So, I mean, for me, what I found, what I took away from that was like, I learned so much just going through that first transaction, because you can study all you want, and you should do your homework before you buy a note, but you're going to learn a lot when you actually go through the transaction. So don't defer that too long. I think the best thing to do is, understand the title work and make sure you're not making a fatal flaw, because there are people out there who will try to sell you just a bad note. So you want to make sure you're not making some fatal mistake that's going to get you zeroed. But beyond that, it's helpful just to get one done, even if the pricing isn't perfect. So I would say as long as you have like some reasonable return, don't sweat it so much on the first one, because once you get through the first one, it kind of sets you up to be off to the races after that. And then down the line is like you get a better understanding of the market, and you build your network of note sellers and different things. Well, then you can kind of like sharpen the pencil, right? But there's just the first one is so valuable. Just avoid the fatal mistake and kind of get it done and get moving.
Well, it sounds like you had a mentor or someone that you could kind of go back and say, you know what, could you just, you know, put a set of eyes on second set of eyes, or can you just double check this? This is kind of what I'm thinking, and somebody to actually rely on, right?
Yeah, and that was a guy who was around the industry at the time that, I mean, I basically paid him to do the review, and he had actually done a number of file reviews for me. He's no longer around the industry because he had some ethical issues, thankfully not related to anything to me. It was a whole thing with him. So I wouldn't deal with that particular guy anymore, but that was helpful at the time to at least like get up and going. And I was just going down YouTube rabbit holes and other things, putting everything together, which is kind of a challenge, right? Because the way notes are, today I kind of have scripts for things and checklists, and it's one of those things where like once you know what you're doing, how to find a note, how to filter to see if it's right for me, how to price it, how to do the due diligence, you can go pretty fast. Like trying to put everything together from like YouTube's and stuff is hard
Right.
to do. It's like trying to draw an elephant, but you're, blind and going around and touching all the pieces.
Yeah. And I mean, in full reality, even now, that we've all been in the space for 5, 6, 7 years or whatever the case may be, even now, the amount of education is still very limited in comparison to, fix and flips and, rentals and there's just there's a whole lot now compared to what there was 5, 6, 7 years ago.
Mhm.
But I do think that, I like kind of what you said there, and I've been really enjoying those emails you've been sending out,
Oh
with
yeah.
the articles. There's no such thing as a perfect note. And I think, we can spend a little bit of time talking about that. And the reality too is a 7, 8, 9% note, you know, may not be a bad note depending on your personal situation, because there's a lot of people. I mean, as you said, I like the fact that in one of the emails you mentioned, the majority of note buyers aren't doing this full time. The majority, they have a W-2, they have some sort of
Mhm.
business. They're just adding, an additional stream of income. And what's the alternative? Where else are you gonna, once you understand and you're in a first position, you're in a safe spot. Where else are you gonna get these, 7, 8, 9% returns right now, especially with the uncertainty in the market, right?
Yeah, it's hard. And the other thing I like about it is basically, and you can get you can get double digit returns fairly simple with, very like stable assets. What I like about it is I can get returns that are higher than the long-term stock market average, but I don't have all the volatility, right? I don't have to, just part of my experience, like I was interested in investing like from the beginning, right? When I was 19, I started buying stocks, and that was like 1995, and I thought I was a genius for a while. Then there was like the dot-com bust, and then and then we had the financial crisis later, and I kind of saw how with equities, they can drop 30-40% really fast, which
Right.
back then when I was like in my 20s 30s, who cares, right? You play a long game, it's fine, like it'll work itself out. But especially as you get a little bit older, right? Like as somebody, if the market hits that 40% down, like when you're about to retire in it, that's hard to recover from. And I don't really know of a place where you can get those kind of returns with the lower level of risk, where you're backed by equity and then you have all the rights of the bank, to enforce the loan. So, but so the thing is, okay, so for as an individual, if you're going to do that, though, it is a little bit of work. So you kind of want a decent return to do it. And so the question is, okay, how do I get 10, 11, 12% on a note with all that safety. It
Right.
kind of has to come from somewhere, right? So the stuff that's like super perfect will get bought by banks, or somebody else with a low cost of capital, right? Because a bank that can borrow for like almost nothing, they just need to make a
Yes.
spread. So that's why
Right.
sometimes people are puzzled, like, oh, how did a bank pay? I'll give you some recent examples from a seller I work with sent me, they were selling some recently originated non-QM loans. So these are institutional loans, not government backed, but kind of the self-employed borrowers. So kind of like really well
Cool.
originated seller finance loans.
Yeah, can you
Yeah.
just dig into a little bit for people that don't know what exactly is a non-qualifying loan? I mean, you're going
Yeah,
into it
so
here
it's
briefly, but
basically, yeah, so it's just basically a mortgage that the government won't buy. They're compliant, and so often these are like self-employed borrowers or ITIN borrowers, people that don't necessarily follow within the guidelines of a mortgage that the government will go by. Okay, but where I was going with that was, um, somebody was sending me tapes of these that had sold recently, and they were selling for like like brand new loans, probably originated at like 8, 9, 10%, selling for 102, 103% of the unpaid balance. Right. So there's a big appetite for like well originated stuff. So as an individual to get a good deal, there kind of has to be something wrong with it
right.
almost. Right. So
Yeah,
that, yeah.
yeah, and I think that's good, to actually for people to keep in mind, right? I mean, the reality is what we deal with is, I know some of our mentors and Eddie likes to call it penalty box buyers. And sometimes, there's just, like you said, there's certain things that we got to be comfortable with and deal with that a lot of institutions or banks wouldn't. And there's a reason, right, that they're coming to us or they're coming to someone to finance a property. And, not everything's going to be perfect, but that's where the opportunity lies. And, we talk about it all the time with Joe, right? There's a big difference too when if you're getting into the note business that you have to understand. There's two things that, Joe and you guys can talk about, but two things that we talk about all the time. Number one is you got to decide when you're going to get into notes. Are you going to be an active note investor or a passive note investor? Because there's two huge differences, right? To where the second thing that I was going to go into is a lot of times we hear notes are fairly passive or passive. There's a lot of work and management, right? That's
Yeah, so it depends on what you're talking. It's like the kind of note, right? So notes might be like a smaller niche, but within that, there's like a million
right,
flavors of notes,
correct,
right? So like at one extreme, you might have the borrower with 800 credit that pays like clockwork, and there's
right,
a really attractive loan to value. Like you'll never have to think about it. The other end of the spectrum might be a non-performing loan that hasn't seen a payment in 5 years. The house is vacant. It's been broken into, and there's title flaws like in the
right,
paperwork. Or what happened to me one time, like, or one of the borrowers passed away and there was probate, and now you got to deal with all that. So they can go anywhere from extraordinarily passive to extraordinarily active. So it kind of depends on what kind of notes you're talking about. But you can get notes that are pretty darn passive and get double digit returns. The thing is, they're passive after you buy them, right? Like there's no, and I even have a video on this made one time. In my opinion, there's really no such thing as truly passive income, but there's a question of how much work you have to do and when you have
right,
to do it, right? So what's nice about notes is the work on a good note can be front loaded, right? So up front, I got to find the note, I got to price it, I got to do due diligence, I got to buy it, I got to get it boarded. So I'm doing some level of work up front. And if it's a good note, then it'll just cash flow for me later. So you can do all this upfront work and then collect. Kind of like my Iowa note, right? Like I haven't
right.
messed with that thing in years.
Yeah,
Yeah.
you did it. You did the good underwriting once, and you haven't really had to do much. Yeah, and kind of where I was getting to is more of in the fact that sometimes people want, like you said, people want these crazy returns. I want 15%, 16, 17% on a note. Like, can you just bring it to me and put it on a silver platter, right? Like, you know what I mean? Like,
Yeah, and that's like, and there's a lot of like ego stuff, right? Like I think a lot of people want to have like the hero stories to tell, like at conferences, areas of how they, like back when there were more non-performing seconds floating around, you heard a lot of those stories where somebody bought a non-performing second for 5 cents on the dollar and it paid off like 3 months later. And the thing is, especially if you do non-performing loans, if you do enough, you'll get those stories. So to me, it's like a numbers game, right? So like when I was doing, let's look at non-performing for a minute, which is a lot more volatile, right? Than the performing. So like I have a model that I buy per, and the majority of the deals will be kind of solid base hits. And on
Right.
non-performings at the time, I was getting like plus 20% returns. I had a couple that got real sideways and then I've lost money on. And then I've had a couple that were like epic home runs where you have like the 100%
Right.
return. So to me, if you have a good model and you go out and you do a bunch of them and you don't put all your money in one deal, well, then that's how it should work out, right? You'll have a bunch of good ones. You'll have some like outliers, and then you'll have some that just get sideways. It's the nature of the beast. Like my deals that have gone sideways, it seems like everything that could go wrong did go wrong, like lined up like on the same one, and that's fine because net it all works out.
It's
That's the
still
other thing
okay.
too. When I was starting in around that 17-18 time, I talked to a lot of people who were like, "Oh, I've been doing notes for 20 years. I've never lost money on a note." And I would say, if you did for 20 years, you never lost money on a note. Like
You didn't buy
you're
any
doing, you're
insurance.
either lying, which I'm sure they were lying, or you're doing it wrong. Because if you do enough, stuff will happen, and that's okay as long as your model's good. Then you think of it as like poker, right? A lot of investors would fold aces because you're not guaranteed to win, right? You be in great shape, you're still going to lose some percentage at the time. That's okay, but with notes, you can just get a really good hand.
Yeah. Well, I don't know if there's anything Joe wants to ask, but I'm excited with everything that you got going on. Where when you first got started, I don't know if you just got a notepad and you had a checklist on what you were gonna look for. Um, what do things look like now compared to when you first got started? And for example, I know you're offering some AI stuff and certain platform to keep
Oh
track of
yeah.
things. So I'd like for you to talk a little bit about what you've discovered over the years on how you were doing things. Let's say that you were looking at 3 or 4 or 5 notes, and now probably expediting to being able to get a lot of information quicker and kind of figure out, okay, boom, within, I don't know, a few minutes or seconds, you can get a lot of the stuff that took you, probably hours.
Yeah, so like when I was starting, okay, so for one thing, the market was a little bit different. So the market always evolves, right? So in like 17, 18, there was still a lot of no inventory floating around from the financial crisis. So there was a lot more distressed stuff. There's more non-performers. There were a lot of like non-performing seconds. Um, and now the market shifted to more of a focus on performing notes. The good thing is there's so many like flavors of notes and different things. You can find good opportunities no matter what market you're in. You just have to know, like you always have to adjust, right? Like there are people, and I think some of those people who are no longer in the business, like another kind of common mistake is people learn, like there were some people who had success during that time frame that like learned a recipe for that market. And then when the market shift, the recipe didn't work and they're like, I don't know what to do. So it's good to have like just a fundamental understanding of notes so you can always adjust. In the beginning, I was kind of obsessed with trying to build like the perfect pricing calculator that I could put stuff in. These days, I don't even really, I mean, I have pricing calculators, but I don't really use them because when you do these, the math is really very, very simple to do in spreadsheets. I just do my calculations in the tape like on the fly. And for me, that's like the fastest thing versus trying like to copy something into some calculator, right? So for one, I've gotten a lot faster just crunching numbers myself. And I always encourage people to just put stuff in a spreadsheet so you can save it. I know like people like to debate like their favorite financial calculator, and yes, it will give you the right answer, but you can't save it. It's not as flexible. You can't like go through a whole tape by just dragging a cell and doing it in 2 seconds. Like just use the modern tools, right? It's funny to me that people are interested in AI, but they somehow skip like the whole spreadsheet thing and they're using legal pads from the 70s. But yeah, but the other thing I've done along the way, right? So I should count up how many note deals I've done. I mean, I own about 60 now. I'm sure bought 150 plus over the time, right? And in that, I've done like a lot of case studies on those. I have a lot of data from those. And so what I did somewhat recently was I took all that data and I put it into a private GPT that you can now ask it questions. So if you're like going through a note deal, it's basically got the whole database of like everything I've ever done. So kind of the old school way was you either like find some mentor that's done it a long time, or you do it for 20 years and build your database of experience. Now with some of the AI tools, you can take the experience of someone from several years, put it in, and then somebody new can kind of go and leverage that without having to go through all of that stuff. Because, believe me, like I made a lot of mistakes and stuff along the way, right? Like there was a lot of stuff I did looking back. I'm like, oh no, I can't believe I did that. So it definitely
Curious,
things up. Yeah.
curious to hear some of those mistakes that, maybe you want to mention one or two on,
Yeah.
maybe some of the
One
mistakes.
big one, my worst deal. So one of the risks in notes is you can't see the inside of the property, right? Because you're not buying, and that's another thing that trips people up sometimes when they start, because they're used to like conventional real estate. You're not buying the real estate, you're buying a loan. So you can get pictures of the property, which you definitely want to do, but you can't go inside. So if it's one that's non-performing where you end up with the property, it's kind of like the old, like what was it? Let's make a deal game where like when you finally get in, there's like the big reveal and it's like, is this like a car or a goat or whatever? And so I did one in Muncie, Indiana, where the house looked kind of okay, but had some peeling paint. There was some junk in the yard, not real bad. And then when we got in there, it was a full blown hoarder house, like literally 3 feet deep of trash. And what I learned on that one and some other ones is whatever flaws, mess, dirt you see on the outside of the house, that's typically the tip of the iceberg. So anything you see that's like bad on the outside, it's probably going to be a whole lot worse on the inside. And I just wasn't attuned to that. And the other thing I've done is amass data on when I've had REOs and they've sold. At one point, this a couple of years ago, I had a list of like 15 properties that I sold. And so I was comparing my initial BPO value to my actual net proceeds when the property sold. And so usually my net proceeds were about 60 to 70% on average of the BPO value. And that's because when somebody does a BPO, they'll do the comps. They might knock down the value based on flaws that they see on the outside, but they can't see the inside, so they don't subtract anything. So your exterior BPO is basically assuming that the inside is flawless. And if it's a property that the borrower is just writing the ship down in a foreclosure, especially with a lender like me, where my whole model is to not foreclose, they live a rough lifestyle. That inside is not going to be perfect. And I wasn't as clued into that in the beginning. For me, that was like a huge one.
Yeah, I mean, those are some good insights, as you mentioned, if you look at the outside of the house and they got some real nice flower beds and it's very well manicured, typically it's pretty well kept inside, right? Compared to there's,
Yep.
a bunch of junk up front, just stuff everywhere. Cars just sitting there
Yeah,
for
if there's
months
junk
and
outside,
years.
there's going to be a lot of junk inside, like just about every time. And then the other thing too was I spent a lot of time early on, like when I would get tapes, putting together offers and filtering, like I would spend hours and hours and hours. But the thing is, most offers you make don't go anywhere. And the other kind of dirty secret is a lot of times when people put out tapes and have loans for sale, they're not really for sale. You know, a lot of sellers will just float stuff out there like they're content to work them, but they'll just send it out and go, oh, well, if somebody screws up and overpays, then I'll sell it. But they're not really for sale. So it was really critical for me to come up with some processes to very quickly look at a tape, filter through, see what works for me, and then get offers together and get them in like fast. And then if you get an offer accepted, that's where you put the time in on those. I think what I did a lot in the beginning, what I see a lot of people do is spending way too much time getting offers on where there's a lot of times you can offer whatever you want. Like, so the assets aren't really for sale, or doesn't happen as much these days, but back when, some of the companies that created a lot of land contracts after the financial crisis were selling them off, like Harbor and, you know, watermarking them. They had a lot of title flaws. So you get an offer accepted, you find out there was some problem with the asset and you couldn't close. So you kind of want to do that initial work really fast and then dig in on the back end when you know you have something. Otherwise, you just waste a lot of time.
You also see uh, periodically people that are selling notes who don't own the notes.
Yeah, so
They
that yeah,
see,
that's common. They call them, you know, joker brokers, right? So that's pretty common is somebody gets a note or a tape and they start going around like trying to sell it, representing it as if it's theirs to try to find a buyer so they can then go to the seller and they can kind of play monkey in the middle. And then what used to happen too is sometimes like multiple people would do that. So you would get like these broker chains. So if you're going to make an offer on something, you want to make sure the person you're offering to is the person who owns it. Or if it's coming through like one of the reputable brokers, like that's what they do, you know, then it's just known, you know, this is coming through a broker. And it's pretty easy to determine who actually owns the assets. You know, you can get in the county records and pull up the assignments and mortgage and, you know, see who owns it and see if that maps to what you have. I'm not the only person this has happened to, but this was like 5 years ago. But there was one time somebody sent me a tape with stuff on it that I owned. I thought that was kind of funny. I didn't mess with them and send it an offer, but
So, so I'm curious. I know you guys are both engineers. Curious, Joe and Dan, what kind of due diligence did you guys do, and at what point did you said, you know what, I'm gonna go ahead and move forward? Did you look at one note and decide to move forward? Did you look at multiple notes and decide to move forward? Um, what did that process look like until you got comfortable enough to say, you know what, I'm actually gonna buy something?
oh, for me, I looked at a bunch. So I started getting a hold of different tapes and kind of just like analyzing notes and running through them to try to do my own analysis to see, you know, how they would work. Um, and then I put in, I'm trying to remember the beginning. I don't know how many offers I made before I got one accepted. I know it wasn't the first one I put in. And for a while, I was tracking how many of my offers got accepted. And this is a little ways back. I haven't kept up, but you know, I was getting like maybe 10% of offers accepted. But yeah, I looked through a lot of stuff first.
yeah, we tend to, um, especially when we're starting out, we tend to overanalyze and look for perfection. And as you said a half hour ago, for the most part, there are no perfect notes unless the underwriting was perfect, the borrower was close to perfect, and those are all bought and sold by banks.
Yeah, like one of my favorite kind of loans to buy are what I call like the subperforming loans. So there's a lot of borrowers who they're not going to let their house go in a foreclosure, but they're not necessarily going to pay reliably every month. You know, so they'll like miss a month and then they'll make two payments and you know they'll do this and that. But over the course of a year, you'll get 11 or 12 payments. So if you're willing to accept like a tiny bit of lumpiness, then you can get a better discount and a better return. Now there is a little higher probability that somebody like that will eventually default, but that's one of the tricks I use. That's one of the flaws that I like that get me a little bit higher return. The other thing I've done a few times this year is, I don't want to nerd out on this too much, but there's kind of your traditional mortgages, deed of trust, and then there are land contracts. Land contracts are, as far as the CFPB concerned, treated the same way as a consumer loan, but for various reasons, because the lender's on title, a lot of note buyers don't like to buy those, right? So all things being equal, a land contract will sell for less than a traditional mortgage. But most borrowers like the idea of being on title and having the traditional mortgage. So one of the things you can do is go around and buy land contracts, see if the borrower is interested in converting it to a mortgage. 90% of the time they will be. And then you do the conversion. Now you've instantly got a more valuable loan on your hands. That's one thing people are real reluctant to do for some reason. I've done it a bunch. I think that's a good strategy as well. Sometimes there's like minor title flaws that you can fix, through somebody like Casey Wilson or something like that. But there's usually got to be like some hair on it to get like a really good return on a loan. So I almost like look for those kinds of things. Or the other thing you can do too is, most of the seller finance loans that are created, probably 90% plus, are created all wrong in violation of a myriad of consumer laws, right? So banks will not buy those. And because they're done kind of Wild West style, individuals don't like to buy them unless they're getting like a really big discount. But if you know something about the borrower and it's a decent loan, maybe it's been seasoned, maybe there was like a good down payment, similar to the land contract strategy, you could go out and buy that loan, get the hefty discount, see if the borrower is willing to redo the paper, and then originate it correctly and turn it into a bank rate loan. Now you can go sell that. So it's not passive, but yeah, there's all kinds of ways you can make money in this stuff. So I almost welcome flaws in notes because I can fix a lot of them. So you can just buy a broken note and fix it and add a lot of value that way too.
Yeah, I mean, that's a great point because people don't even think that that's even possible when it comes to note. They just think you buy a note and it pays or it doesn't pay, and that's kind of it, right? There's just so many aspects to notes, and we can spend all of today talking about notes, and we can spend the next several days just talking upon hours. There's just so many aspects when it comes to the different aspects when it comes to note investing. But that's a great point, right? Like you can add value into notes by multiple ways, right? That's the other thing people don't realize. If somebody gets in trouble, you can help them out, right? But on the flip side, increase your yield, right? Through
Yeah,
different things.
and some people will say, well, what if the borrower doesn't cooperate, right? Because the borrower has to cooperate. There's like another party you don't control. And so all you do in that scenario, you make sure you buy it at a price that it makes sense. Okay, if I can't improve the note, this investment makes sense on its own. And then if the borrower does cooperate, the deal is going to get better. And like anything else, it's a numbers game, right? So you do a bunch of these. Some percentage of the borrowers are going to cooperate, some percentage or not. And that's fine.
So since you do have called the underwriting, let's just spend a few minutes talking about, you just mentioned something a few minutes ago, which is true. A lot of people that originate notes originate them to the best of their ability and to the best of their knowledge. But there's something that people don't realize is when you're selling to a consumer, a family, somebody that's going to be living in the property, what are some of the things that you see that aren't being done that people should do, right?
Yeah. So basically there's a lot of different consumer laws. So basically the way I think of it is, if you're making a loan for somebody and if they default, it means somebody's losing their primary residence. That's when all these consumer laws kick in. So big one is Dodd-Frank. You got to validate that your borrower has the ability to repay, make the payments, which for me, if I'm making a loan, I want to do that anyway. So Dodd-Frank doesn't tell me to do anything that I'm not going to do anyhow. And then the other big one is TRID, the TILA, RESPA, integrated disclosures, and TILA and RESPA are their own acronym. But basically what it means is you got to send a loan estimate to your borrower 7 business days before you close so they can read all the fine print. The kind of the intent in that they don't want lenders like winging changes that a borrower at the last minute at the closing table. And then you got to send them a closing disclosure 3 business days before you close. Well, I want everything disclosed, right? When I've had non-performing notes and borrowers have gotten angry, they usually reference some old disagreement with the old lender. I thought this was going to be like this. That's like not having things disclosed, like whenever you're potentially off, not on the same page, that increases your chance of default. So that's kind of something that I want to do anyways. Those are the big ones. And then there's also like limits on fees you can charge and stuff like that. But basically all that stuff I want to do anyways. And then, if you use an RMLO, you can pass the cost of that on to the borrower at closing. So I find it nuts that people don't just do the compliance stuff because 1, it's stuff you want to do anyway. It's in your own best interest. And 2, it doesn't cost you anything to do
Yeah,
it.
I mean,
But most people don't. And that creates opportunities because you can go buy that paper and fix it.
right.
Yeah.
Yeah, no, I mean, we do that all, on our, we mostly originate. We don't buy a lot just because we originate. So yeah, that's one of the something we're just upfront with borrowers, and we just say, hey, part of going through all this, there's an RMLO fee that you're going to have to pay for. And I explain it and break it down. And the way that we do it now with one of the ones that we use is it's a few $100s up front. And we say, hey, as long as what you've told me, because I basically do an interview, right? What's your
Mm-hmm.
monthly income? What's your expenses? I roughly go over a payment. And based on that interview, I say, okay, once I get a good feel, like they're going to qualify, right? I won't know obviously until I run them through the Armello, but I have a very good idea, and I let them know if for whatever reason something comes back that, doesn't check out, you're not going to have to, pay that full Armello fee. You'll just have to pay the few $100s so you're not out the full, whatever, $1,500 or so. But we're
Yeah.
upfront, and like you said, it's just the same thing when people go and get a bank loan. It's not like you're negotiating with the bank. Well, you know what? I don't want to pay this origination fee.
Yeah, you're going to
Okay,
have
well,
fees
don't get a
with
loan.
banks.
You know what I
And
mean?
when they're doing
So,
seller finance, right, you're providing a service to them that they can't get from a bank, or they would, and they would get a lower interest rate. The last trick, and then I'm going to get kicked out of this room in about 5 minutes, but um, I mentioned earlier that there's this proliferation of non-QM lending programs from various institutional wholesale lenders, right? And the profiles they're targeting are often like your seller finance type borrowers. So non-QM a couple years ago was like maybe 1-2% of the mortgage market. And then in 2024, it went to 5%. And in 2025, it's going like to 8%. So there's all this new stuff that like wasn't available even like 6 months ago. So the other trick you can do is you can go buy, assuming you got a decent borrower, buy a seller finance loan, say in Texas, that's written at 11 or 12% interest rate. Point your borrower to a non-QM, hey, would you like to, maybe you can refinance, and they refinance at like 8%. And if you bought that loan at a discount, you can engineer a payoff, an early payoff for yourself. So there's all kinds of things you can do beyond just like buy a performing note and sit on it. Or, the other mistake a lot of people make is they chase notes that existed in a market from like 10 years ago that you're really not going to find these days.
Let's talk about that early payoff for just a second.
Mm-hmm.
The unpaid balance on the note is this. You buy it at a discount, you negotiate, or you help them negotiate a replacement loan. Your loan is paid off. Who gets this?
Yeah, the note holder does, right? So like, let's say, like, just give a number. Let's say I buy $100,000 note and I pay 90,000 for it. So I get a $10,000 discount. If the borrower refinances and pays it off, I get the 100. So
Right.
you can engineer yourself these little pops.
so what does that? So what does that do to your yield? Let's say that you bought it at 11% yield, for example. Now you got a $10,000 payoff, for that spread, and 12 months.
Yeah, it depends on how long it is, right? But
Right.
I mean, the closer it happens to when you bought it,
Right.
yeah, it can increase it dramatically. That's one more story. I did have a loan one time I bought where I was going through a tape and I noticed one of the properties was for sale, and I quickly bought the note and closed on it. And then like a couple of weeks later, I got a full payoff. I don't know what the return on that was, but yeah, that was very high because I captured the discount like right off the bat.
So what you're telling me is that there is a possibility of getting 15, 25, 30, 40, 50% on notes.
Oh, totally. Yeah.
Yeah. Okay,
Yeah.
awesome. Well, like you said, I know we do got to wrap up here, but I'd like for you to spend the last few minutes talking about, the Note Copilot and some of the software, and you also offer mentoring and coaching and educational stuff for people that really want to understand the note business, right?
Yeah, so what I've done along the way is like I've kind of packaged all the systems I've built. So the first one is the Note Launchpad online training course. So that's like 30 hours of videos, checklists, calculators, people they can download. It's basically like an encyclopedia of notes, and there's lifetime access to it. So you kind of have this big encyclopedia like to go search that's always there versus like doing some kind of live training. We got to remember everything, or especially like you get into some of the corner cases with non-performers. You may have learned about it 2 years before you actually need to do it. So it's good to have that as the
Go
reference.
back.
And that goes through everything from the fundamentals, how to source notes, like my buyer's list, due diligence, pricing, operating a portfolio, workouts, how to take on outside funding. It's just like everything all in one. And then recently, to kind of go along with that, I released what I call the Note Copilot. So that's where I took all the transcripts from those 30 hours of videos, like all the info from the course, a bunch of other like private data that I wouldn't necessarily put in a course, and other things that I've created and case studies I've done. And so it's in a private GPT. So now, because basically what I was trying, the problem I was trying to solve with Note Launchpad was how do you get something that's not fantastically expensive and you can kind of reference at any time, right? And then I kind of really like the next challenge was, okay, it's great to have 30 hours of stuff, but sometimes it can be a challenge to get to like the nugget that you need. And so that's what Note Copilot's for, because everything is in the AI. So now you can just ask it questions as you go, and it will kind of guide you through a deal. And you can also do things like upload, you can upload loan documents and say, tell me the key terms and extract it versus trying to go through them. You can upload pay histories. It'll say, tell me about this pay history, which is a lot easier than, going through everything manually. So, and so for me, it's been nice because like I built a lot of this stuff for myself. And then one, if you teach something, it's like the best way to like really beef up your own understanding of it. So for me, it's a nice forcing function to dial in, to dial in my systems, but then it makes it easier for people to participate and get started without having to spend, 8 years like I have going through all that stuff.
Yeah, so I think, obviously we know it's, Thanksgiving's around the corner, and hopefully we can release this video here in the next 24 hours or so. And I think you have
Yeah.
a special right now.
Yeah. So there's a Black Friday sale on right now. So if you go to notelaunchpad.com, you'll see that. And then, if you're watching this like after the Black Friday sale, it might look a little bit different, but
Yeah, we'll make sure to link all the,
yeah.
promo codes information, and, people can subscribe to your newsletter, phenomenal newsletter.
Yeah. So if you go to the fusionnotes.com, you can get on my newsletter for note buying. And then if you go to calltheunderwriter.com, I've got a separate newsletter for note creating. Yeah.
Any last minute questions, Joe, before we
Well,
shut it down?
I just want to say, Dan, thank you for your leadership in the industry. You're well regarded, well respected. Uh, Thank you.
Oh, thanks. I appreciate that. Yeah.
Yeah, no, we definitely appreciate you. Thanks for making some time. I know people are probably going to want to follow up, interview talking about, because there's just so many things that we can dig further into. And like you said, you spent a lot of hours in education. I mean, how many hours in,
Oh gosh, I don't know.
investment,
Over
you
8
know?
years, a lot. Yeah.
Yeah. Yes.
Thousands.
Yeah.
I know
Yeah,
I've spent thousands.
yeah, I mean, sometimes it's silly. Some people,
Yep.
you know, I like to make, oh no, like we've all spent tens of thousands of dollars on education and then just a lot of hours, it takes time to learn all this stuff, and I will say when it comes to notes, it is a little bit boring in a sense, but it's incredibly.
Yep. All right. Well, thanks, guys. Appreciate you having me on.
All right.
Yeah.
We'll talk soon. Have a good one. Thank you,
Thanks.
everybody. Bye-bye.
All right. Cool. Well, I'm getting the hook, so I'm going to start packing up here. So, well, thanks, guys.
Appreciate it.
Yeah, let me know. Send me the